Samit Vartak. He's joining in as CFA, CIO and partner at SageOne Investment Advisors. Samit, great to have you on board. Thanks much for taking the time out and joining in. Let's talk about your outlook for 2020. While the markets have been perched at those all-time highs, we've been talking about that complete divergence. The macros haven't quite played catch up. The earnings haven't been in tandem with expectations. What's the outlook for 2020 on these two parameters?
Right. So overall, it's a very difficult thing to predict going forward. I think investment is all about probabilities. So if you have valuation in your favor, things work out. But I think it's more important that as an investor to focus more on the individual companies rather than trying to predict the macro, which is the most difficult thing for even the best of economists. So forget about the investors. So I would rather focus on the companies. There is a huge opportunity available because the valuations, especially if you leave out few of the leaders, whether it's in the large caps or whether it's in the mid caps or small caps, there is tremendous value available today. And generally, if value is in your favor, things do work out in terms of your investment returns. But I think it's more important that you focus on the leaders in each of the categories that you would be interested in. Focus on earnings growth because India is where earnings growth is available. The last couple of years are not norms. I think it's an odd period out, and India should get back to the earnings growth. I think if you focus on earnings, the category leaders and valuation, generally things should work out in your favor.
Since your last memo, lots has changed, both slashing of the corporate taxes to resolution of the SR case, clarity coming in with regards to the IBC process, and the overall slowdown that one has seen in the economy, which began with autos and now has had a trickle-down effect to the rest of the sectors of the economy as well. What is that telling you about how soon could we see an earnings revival? Is it going to happen this January, or is it still a long wait of another 2 to 3 or maybe longer quarters?
Yeah, I think the biggest hurdle for earnings growth in the recent past has been the interest rates. I think the credit cycle is the biggest problem for the Indian economy. This started in 2011-12, and then the credit cycle has slowed down over that period. The biggest problem today is that the interest rates that the companies pay, is in double digit. It's 10 to 11%, whereas your nominal GDP for last quarter was 6.3%. So until the interest rates are above the nominal GDP, it's extremely difficult for corporates to borrow. So it's not just supply of credit, but also the demand side of credit, which is very difficult. So see, I think there are certain steps. The most promising step for me has been the lowest tax for new manufacturing companies would be able to set up factories and then start it by 2023. That itself, I think, should spur capex because once your tax rates fall, your IRR or the hurdle rate, also drops. So but the problem is that this was announced in September. To plan your capex, to get environmental clearances, to get all kinds of approvals, it would take 9 to 12 months. And even though things might be promising from that end, I would expect, maybe the capex cycle to revive probably towards the September quarter or so. And hopefully, there is, I think, the tailwind from the global scenario, because you would see that the agro commodities have started picking up. The general commodities across the world are picking up, and generally that's a good tailwind for the emerging markets, and that should revive some demand on the global side. And I think things are falling in place. We have a pretty much stronger banking. It is relatively strong compared to what existed 4 years ago. It's capitalized. We have significant liquidity in the banking system, more than 2 trillion rupees. And then the interest rates, hopefully over a period of time, once the economy normalizes, will come down, because the repo rate of RBI is pretty low. It's just that the companies who want to borrow money have stressed balance sheet. So until the demand picks up, the lenders won't be willing to lend, and it's a catch-20 situation where unless the balance sheet gets stronger, the lenders don't want to lend. And even if they want to lend, they want to lend at much higher rate than the nominal GDP. So that's an issue, I think, which will get resolved over the next 2 to 3 quarters.
All right, fair enough. Let's talk about the trend that we've seen in autos as well then. And Samit, without a doubt, this has been one of the most beleaguered sectors. You've had a slowdown seen across the board, being reflected in the monthly auto sales numbers. Is there a chance or some sort of a reversal in the trend that you're seeing?
See, auto has structural, problems in addition to the cyclical problems. So I think it's going to be very difficult to predict that revival. I would rather bet generally on overall capex cycle picking up. But auto is one of the. Hello. Yes, I can. Yes. Right. So I think we got disconnected. But auto is a very difficult sector.
It's a difficult sector to predict, but we will get in a sense as to, there is some sort of a hope of reversal of the kind of slump that we've seen in Motown as well. The NBFC sector, without a doubt, has gone down as one of the, most unfortunate events. The crisis has had a spillover effect. Credit growth has slowed down. The liquidity situation has tightened quite considerably. Do you believe that we're out of the woods just yet? And what's the way forward? Are you selecting, some of the only the quality names within the NBFC space if one had to bet for 2020?
See, I would like to, provide the analysis that I presented in my memo, the recent memo that I released. So financial sector was one of the prominent sector which appeared. So what I did was I looked at the slowest period in the Indian earnings growth phase, which was the last 8 years, and I said, let me look at companies which have been multi-baggers, which is basically I look at 26% kind of CAGR in terms of return, and I found that there were 68 companies in the top 800 companies which were multi-baggers, and out of them 85% of the companies were commodity kind of companies which provide commodity services or products. And the prominent ones out of those were there were the financials, so the private banks, some top NBFCs, there were specialty chemical companies. So opposite to what the common consensus is, that you got to look at B2C kind of companies, which are consumer oriented and which do not need much of capex to grow. The actual results showcased the best returning companies where they were having decent ROE, 20 to 25 or 30%, but they had huge opportunity to grow. And they had a huge opportunity to reinvest their capital. And NBFCs or private banks are the ones where the growth opportunities is tremendous. So I think if you focus on the leading financial companies in each of their categories, that's the way to go. Irrespective whether it's an NBFC or a private bank or an insurance company, I think if you focus on the category where there are 1 or 2 dominant players, and then the remaining are, weak, which provides you an opportunity to, take market share away from them. I think that's the way to go forward.
And Samit, you've been bullish on the chemical space. What is it that you're advising, and any other pockets or mid-cap ideas that you'd like to share?
No, so chemicals is a space which is a long-term structural story for India. Again, there you have to focus on the category leaders in each of, whether you look at the benzene chemistry or the fluorine chemistry. you have to focus on the leaders and look at players which haven't just benefited because of Chinese shutdown. There are players which have been doing pretty well over the last decade, and many of those companies have become 20x, 30x. And it's not just because of the Chinese slowdown. Chinese slowdown is something which has been lucky for a lot of companies, but you don't want to bet on luck. You want to bet on company managements which have seen this opportunity well ahead of time, and they are the most efficient player even if you compare that with the global players. And I think that's the way to go forward in the chemical space. Other than chemical and financials, I am also positive on building materials. So again, there you have to be very specific. Building material can be cement or tiles, but it's a pretty scattered space. You have to find space where there is a one leader or a two player who are very dominant, and then the remaining space is weak. You'll find that in the steel pipes. I'm not talking about the steel pipes which are used in oil and water, but more to do with the building commercial space or infrastructure, airports, even the door frames, and multiple uses. And once the capex picks up, I think the demand for that is going to be humongous, because there hasn't been much capacity built up. There are one or two players who have put up the capacity, and those players have gained market share, plus they have grown even in the worst of the growth phase for India. So once the growth phase comes back, it's much easier for them to grow. And there are many such players who have multiplied their sales at 25, 26% over the last decade, and still available at 15 to 20 times multiple. And they have grown, and their balance sheet is as strong as many of the consumer-oriented companies. But because it's a B2B kind of business, you get such a great valuation, and that's where I think the opportunity is today.
All right, Samit, lovely having you on board. Thanks so much for joining in, and all the very best for the new year.
Thank you so much, and wish a happy new year to you and all the listeners.